those of you who have attended events with us in the past, we provide a series of educational classes and seminars that we brand Courses for a Cause. There's no obligation, but we always like to tie the educational event to a charitable cause. EPM is a big supporter of David's Dream and Believe Cancer Foundation, a local nonprofit in New Jersey that gives back directly to the community and families who are battling a cancer diagnosis. So if you feel so inclined, feel free. You can make a donation to directly to the foundation by texting Equity EDU to 91999. Again, no obligation, don't feel pressured, but just something that we always throw out in the beginning of these classes. For those of you who have attended some of these classes in the past, right now we do offer a series for CE credits as well. We have 3 current course offerings. All 3 on the screen are offered as both 2 and 3 credit hour courses. We can also teach these in smaller segments, not for CE. I know the CE deadline literally just passed. Hope you guys all got your CEs in for all the agents on the call. But we have a series of additional classes that are in development and being approved in different state real estate commissions across the country as well. So if you have any interest or questions about Courses for a Cause, feel free to reach out to myself or any of the other contacts at EPM, and we can share more information on this. All right, so the topic of today's conversation is going to be focused around the headlines that we've all been seeing over the past couple of weeks. And for those of you who do subscribe to our newsletter, we put a newsletter out 2 weeks ago about the question, is there really a new unfair mortgage credit tax on those with high credit? So a lot of you have heard about this, seen this in the headlines. This is just a screen grab from Fox News that was floating around on the internet, mentioning that people with a 620 FICO score get a significant fee discount, and borrowers with a 740 FICO score are now paying a 1% fee. So we're going to dive into this, really try to make heads and tails of what this means. Before we do that, though, I want to just take a minute and step back and kind of give some background on these fees in general, and answer some basic questions. One, starting with who charges these fees? Are they charged by lenders? In fact, they're not. They're charged by government-sponsored enterprises, what we also refer to as GSEs, or sometimes we'll hear us call them the agencies. The GSEs are Fannie Mae and Freddie Mac. Okay, so Fannie Mae and Freddie Mac are overseen by the Federal Housing and Finance Agency, the FHFA, and they exist for really one reason, which is to make homeownership more affordable and readily available, make mortgage financing more readily available for home buyers all over the country. So what they ultimately do is they buy the loans that we write and fund as lenders. All right, so they're purchasing loans from lenders on a regular basis. We typically sell loans immediately to Fannie Mae or Freddie Mac, conventional mortgages, right upon closing. And it's also worth mentioning that these GSEs are only purchasing conventional mortgages from lenders. They're not purchasing government loans, which would be FHA, USDA, VA. Those loans are actually purchased and insured by a different entity called Ginnie Mae, which is not a GSE. So for the topic that we're discussing today, we're going to focus on Fannie Mae and Freddie Mac. They purchase loans from us, and they ultimately allow us to recycle our money so that we can write more loans for more homeowners, right? So no bank, regardless of how large they are, whether they're, Wells Fargo, Chase, Bank of America, the 3 largest banks in the country, or a moderate-sized mortgage banking firm like EPM, none of us have enough money to write loans over and over and fund loans on a monthly basis. We would run out of cash. So what we do is we sell the debt back to Fannie Mae and Freddie Mac. They give us our principal back, and then we go and make another round of loans the following month and make homeownership financing available to more and more people. So what the Fannie and Freddie don't do, though, is retain servicing. Right? They don't collect the mortgage payments. So when we sell the debt back to Fannie Mae or Freddie Mac, we are retaining the servicing rights as lenders, and we're collecting those mortgage payments going forward. And we get paid for that. Okay, lenders make 0.25% of the interest they collect every month on the payment, and then they pass on 99.75% of that interest and all of the principal back to Fannie Mae and Freddie Mac. All right, so that's the nature of a GSE. And it's important to understand that when we talk about the fees that were just in the news. So what exactly are these fees? So the fees have a specific name. They're called loan level price adjustments, or LLPAs for short. Okay, so these are risk-based adjustments to the price of an interest rate. And that word price is important. Okay, what it does is it increases the cost of the rate. It doesn't increase the rate itself. This is important to understand. It's based on risk, right? So the higher the risk, the higher the costs of the financing, and the lower the risk, the lower the costs. So the other thing about these fees, these loan level price adjustments, is that they're charged equally to all lenders across the country. And they're charged to us as lenders when we sell the loan to Fannie Mae or Freddie Mac, to the GSEs. So that date that we sell the loan is what's known as the delivery date. Okay, so it's not the closing date. It's the date that we actually sell the loan and deliver the loan to the GSE. That's when these actually get paid. So these loan level price adjustments are charged for a lot of different features on a loan, including credit score, loan to value, loan purpose, occupancy, the number of units, different property types, whether it's condominium, multifamily property, and they're charged as a percentage of the loan amount. So they're basically charged as what we would call points, right? 1%, 2% of the loan amount, 2.5% of the loan amount. They're also charged cumulatively. So they add up, right? Because there's different risk factors. So you could have a charge for FICO score, and you could have a charge for the property occupancy being an investment property, right? They get added together. So they're cumulatively charged. So that's what these fees are. So when did these fees actually change? Well, they actually changed months ago, even though we're just hearing about it in the news today. Again, they're charged at the time that we deliver the loan to the GSEs, right? So loans are delivered weeks, sometimes months after closing. So the lending industry actually started charging these costs to borrowers back in Q1, some as early as January or February, depending upon how long the loan was locked for prior to closing and prior to delivery. So we're just hearing about it now because it takes effect for loans that lenders deliver to the agencies after May 1st. Okay, so that's why it's hitting the headlines, because the effective date was May 1. But again, they've been charged for some time now, and they've been built into the pricing for interest rates, buyers that have bought houses in March, April, leading up to May. So where can we see these fees? Anybody can see these fees. Okay, these LLPAs are all public information, and there's a website you can go to at fanniemae.com. The easy way to get there is just simply Google LLPA. If you Google LLPA, this will be the first hit. This is the matrix, and you can see what these fees are. Again, these fees are charged equally by the agencies to all lenders. So it's not like one lender gets a different price than another. It's all public information, and anybody, including consumers, can see these price adjustments. And this is kind of what they look like. So when you look into the matrix, there's a series of tables. So this example here, what I've highlighted is a borrower with a 740 FICO score. You can see the credit score column over here at the far left. And you can see that there's different tiers of credit score. So they move in 19-point increments, with below a 639 being the bottom and above a 780 being the top tier. So for right now, I'm focusing on the 740 to 759 FICO score range. And across the top, you have the applicable loan to values. right? So here I'm focusing on 75.01 to 80% loan to value. So this would be basically less than 25% down, right? To 20% down. So this is, in this range, someone with a 740 to 759 FICO score, that's putting between 24.99 and 20% down, we would have to pay as a lender 0.875% of the loan amount upon delivery of the loan. Okay, so that's a fee that, again, is charged to us as a lender. Lenders pass these fees directly onto the consumer. All right, so this is kind of how you would look at and understand the table. So on the contrary, here's a borrower with a 660 FICO score and the same down payment. So that borrower would have to pay a 1.875% fee. So you can see when we look at them together that the higher the credit score, the lower the fee. The lower the credit score, the higher the fee, right? It's risk-based, right? The lower FICO score ranges represent a greater risk of repayment, a higher probability, technically, of default on the mortgage. So it's riskier to lend someone with lower credit scores money. So it costs more, right? They have to pay higher fees. So that's the general concept behind risk-based pricing adjustments. Okay, again, keep in mind, this is affecting the cost of the interest rate, not the interest rate itself. This doesn't mean that a borrower with a 660 FICO score is going to get a 1.875% higher rate. It just means that their closing costs are going to be 1.875% of the loan amount higher than someone with better credit, right? In fact, it's 1% worse than if they had a 740 FICO score. So you may have noticed, if anybody was paying close attention, that the cost for loans with less down at higher loan to values, lower down payments, had higher costs. So if you look at the chart, you can see between 85 and 90% loan to value, right? A little over 15 to 10% down, or 5 to 10% down, or less than 5% down. The fees are smaller. This is an anomaly because of the requirement of mortgage insurance. All right, so if you're putting less than 20% down, the costs decrease because there's insurance on the loan, right? So the PMI that a borrower has to pay on a mortgage with less than 20% down decreases the risk to Fannie Mae and Freddie Mac, right? So if the borrower defaults on the mortgage, that private mortgage insurance policy is protecting Fannie Mae and Freddie Mac. And it's guaranteeing repayment of between 25 to 35% of the loan balance, right? So that insurance is valuable, and it decreases the risk of lending someone money with a smaller down payment. And that's why you see the cost decrease. You can see at the 720 category, with 20% down, someone has to pay 1.25%. But if they only put 5% down, they pay less. They pay 0.875. Again, that's due to the application of PMI, which reduces the risk and ultimately lowers the loan level price adjustment. So just an interesting thing to point out about PMI and smaller down payments. So what else are these fees charged for? So far, we've just looked at how they impact a loan price based on FICO score and loan to value, but they are charged cumulatively for other risk factors. So some other common risk factors are condominium risk or property type. Condominium risk is a good example. So within the table, you'll see that there's additional risk for condominiums. And as the down payment gets smaller, as we move further across the table, you can see that the costs start to increase. The loan level price adjustments increase. And there's a big jump from 25% down and above, right? So the cost increases from 0.125% to 0.75%. Some people will always ask, what is the risk associated with a condominium? Ultimately, just to touch on it, if you have a condominium versus a single family home, you're part of a project or an association. So the financial stability of the condominium comes into play. The overall condition of the property can increase the risk. Again, it's a shared building. If something happens to the collateral, to the building itself, that affects the marketability of the property, the ability to resell it. Owners have limited control in a condominium, right? They can't make all the decisions themselves. They need to get approval of the association. All of these things add to risk. You often see higher tenancy concentrations, and also the potential for lawsuits and litigation. So all of these things increase the risk when lending money on a condominium, and that translates directly into an increased cost for a mortgage on a condominium. In fact, it's a 0.75% additional cost adjustment with less than 25% down. So this is another example of how these price adjustments are implemented based on risk. The risk of lending someone money and the odds of them repaying, or the ability to recover that money borrowed. Some other examples of risk: investment properties and second homes carry additional risk. These loans have the highest likelihood of default during a financial hardship. So basically, if someone gets into financial trouble, it's the first to go. That's the theory, right? They're going to, someone who has an investment property is going to pay their primary mortgage first. They're going to let the investment property go before they let the roof over their head go into default. So there's also increased risk to collateral with investment properties because of tenancy, right? Tenants don't take as good care of a property as an owner occupant. So all of these things add additional risk, and you can see how the risk is applied in the tables. So again, as the down payment decreases, the costs increase, and these are now the same. These investment property charges are the same for second homes as well. So for the most part, we typically don't see investment properties or second homes written with less than 25% down. And at that 25% down mark, you can see that an additional 2.125% LLPAs are charged. So that's a significant cost increase, and ultimately why investment properties and second homes come with higher closing costs and interest rates. Above 75 LTV, if we're putting less than 25% down, you can see those costs increase dramatically, to the point where it's over 4 points. And this is why you typically don't see any financing over 75 LTV for a second home or investment property. It's just too expensive. And it's oftentimes cost prohibitive for someone to put less than that down. Other property risk, just to run through the table: multi-unit property. So multiple units also represent a greater default rate, a higher risk. There's obviously tenancy involved if you have more than one unit. Property conditions are a concern. So you can see in the table that any 2 to 4 unit property, again, as down payment decreases, the LLPA, or the risk-based adjustment to the cost of the rate, increases. So this is how you would read the table, and just to give you a general understanding of what these LLPAs are and how they impact the cost of rates. They've added some new ones. Okay, they just added this one in effective May. So debt ratio. Someone with a higher debt to income ratio represents a greater default risk, right? They have less money after all their bills are paid every month, and a greater chance of falling into some sort of financial hardship. So there's now additional risks associated and costs now with someone with a higher debt to income ratio. So this is a brand new one that just went into effect on May 1st. But all of these are examples of how Fannie Mae and Freddie Mac assess the risk of lending someone money. So how are these fees paid? This is important to understand, right? So paying for these LLPAs, they can be paid in cash, right? So again, they're a percentage of the loan amount. So they can be paid in cash as closing cost, but more commonly, they're paid with what we call a rebate. Okay, so the GSEs, Fannie Mae and Freddie Mac, give lenders a rebate, and they give it to us as a percentage of the loan amount at higher interest rates. So in this table that I have on the left of the slide, this is just a generic made up rate sheet. And what it shows here is that in this example, 6.5% is the rate that we would call the par rate, okay, or the best executed rate. So this is the rate that costs the borrower nothing. They're paying no points here. Any rate below 6.5, you can see these numbers start to get bigger in red. These are points, right? So if somebody wanted a 6.25% rate, they would have to pay 1% of the loan amount as a fee. Well, the opposite is also true. At higher interest rates, there's no fees, but Fannie Mae and Freddie Mac actually pay the lender back a rebate, right? So these are expressed as a percentage of the loan amount. So at 6.75%, Fannie Mae would pay a 1% rebate back to the lender. So it's the higher the rate goes, the larger the rebate percentage, right? So if we go all the way to 7.5, you can see in this made up example, Fannie Mae would give the lender a 4% rebate. So on a $100,000 mortgage, that would be $4,000. So these rebates can be used to cover the LLPAs and pay the LLPAs. And this is often why you would see higher interest rates on loans with more risk. Okay, so I'm going to walk you through an example. So here's an example of a $300,000 loan on a primary residence. Okay, and I'm going to make some assumptions. So first, let's just say that our borrower has a 725 FICO score and is putting 20% down. So if we look at the table here, we can see here's our 720 credit score. Here's our 20% down, 80 LTV, and we have a 1.25% LLPA that gets applied. Okay. So we also, let's say hypothetically, the borrower has a debt ratio of 43%. So now the DTI is over 40. So this additional loan level price adjustment applies. So cumulatively, this borrower is paying 1.625% of the loan amount. So how's it going to be paid? Well, if we look at the rate sheet, at the rate of 6.5%, there's no rebate. Okay, so in this scenario, the buyer or borrower would have to pay 1.625% of the $300,000 loan amount, which comes out to $4,875 in cash at closing. And so it would be affecting their cash at the table and increase their closing costs. If they don't have $4,875 to pay these points, and then there's another way that we could do it. We can use a rebate. So we can move up the rate sheet to a 6.875% rate. We would get a 1.5% rebate from Fannie Mae, and that would be applied towards the total 1.625. Right. So in this scenario, they only have to pay 0.125 in cash. So now they only have to bring $375 to the table as a closing cost, and they're paying the LLPA through the rebate. Okay, so the difference in payment between 6.5 and 6.875 is $75 more per month, but it requires $4,500 less cash. Right? Most people do not want to pay this in cash. And when you do the math on it, it doesn't make sense to do that for a $75 increase in payment. So almost everybody would take the higher payment. And this is exactly why someone with a 720 FICO score is going to pay slightly more than someone with a higher credit score, right? And get a higher rate, because we're going to use the rebate from that higher interest rate to pay the loan level price adjustment. So this is a primary residence example. Okay, I'm going to shift gears and I'm going to run the same scenario as a second home. Okay, so in this scenario, okay, we still have the same 1.25% adjustment for FICO. It's right here. We still have the 0.375% adjustment for debt ratio over 40. But in this case, we're also adding in a new loan level price adjustment of 3.375 because it's a second home. This is the occupancy adjustment. So now as a second home, the cost of the financing just increased dramatically, right? It went from 1.625% on a primary to 5% on a second home. So if we look at the rate sheet again, still 6.5% doesn't pay a rebate. So in this case, the second home buyer would have to pay 5% of $300,000 in cash. That's $15,000. It's a lot of money, right? Alternatively, we could use a rebate to pay that. So if we wanted to pay the entire 5% adjustment in a rebate, we have to go up the rate sheet to 7.875% to find a 5% rebate. So with that higher interest rate, they don't have to bring any of that to cash to close. And they would, although they would have a $260 higher payment. Okay, so no cash at closing, significantly higher rate and payment. This is why on second homes and investment properties, we typically see significantly higher interest rates, because no investor or most buyers do not want to pay these additional adjustments in cash. Okay. Additionally, I used as an example specifically here a 20% down payment on a second home. We very, very rarely see that, because if you look at the adjustment difference here, you know, with an additional 5% down, that adjustment drops to 2.125. Okay, so almost nobody puts less than 25% down on a second home or an investment property because of this huge difference in cost. You know, that's we see most, almost all investment properties and second homes at 75 LTV with 25% down. But this is exactly why interest rates are higher on second homes and investment properties, because we need larger rebates to pay the cost. So what's changed? All right, now that we've talked about, you know, who Fannie Mae and Freddie Mac are, their role, what the LLPAs are, what's all the hubbub in the news, what changed, right? So first of all, this table kind of shows the percentage change of the FICO score, loan level price adjustment, and loan to value. Okay, this doesn't take into account anything else, but just looking at the news headlines, they're focused on credit score, right? So you can see just by this heat map, okay, the red areas are going to show the largest percentage increase from the old LLPAs to the new LLPAs. And the green areas are going to show the improvements, right, or the decreases. So you can clearly see that people with a 660 FICO score or 679 and below saw the biggest improvements in price, right? Their costs went down. And you can see that people with better credit saw increases in their costs, right? And so this is what the news and the media latch onto. And they say, oh my gosh, you know, people with better credit are paying more, and people with worse credit are getting a break and paying less. Well, that is true, right? That is true. But if we look at a different picture and we look at the outright change and the outright costs associated with credit score, you can see that people with worse credit are still paying, these are the actual costs they pay, they're still paying significantly more, okay, than people with good credit. So it's not that they, you know, stole from the rich to, you know, robbed the rich to give to the poor. They increased the cost for the middle borrowers the most. They decreased the cost for the lower FICO score borrowers, who are still, however, paying significantly more than anybody else. But the percentage changes is what the media latched onto. So to take it a little further, the other thing that they did is they increased costs for 740 and better borrowers. So before this change, again, the top tier of our table shows what people with a 740 or better were paying. Right? So there was no brownie points for having a 750, a 760. There was also no penalty for it. Well, now they've increased that top tier, right? So they've added these new categories, 740 to 759. So now someone with a 740 and 20% down is paying 0.875%, right? Where before they were paying 0.25, or I'm sorry, 0.5. So there's been a change to the top tier as well. So they've widened the playing field as far as credit goes, and increased that top tier score. So looking at the closing costs prior to May 1st, this is the old table that topped out at 740. So you can see someone with a 640 to 659 FICO was paying 3 points with 20% down at 80 LTV. Okay, someone with a 720 to 739 was only paying 3/4 of a point. So, obviously less, right? Well, now that 720 borrower is paying 1.25%, and the 640 borrower is paying 2.25. So the 640 borrower is paying less. Okay, their cost is 2.25% now. That's down from 3% before. So they got a price break. The 720 borrower saw a price increase of 0.75. So that was a half a point increase, right? So their cost went up to 1.25 from 0.75. But still, the lower credit score borrower is still paying considerably more money, just not as much, right? So it's making it a little more affordable for someone with worse credit to get a conventional loan. Not everything increased. Okay, some of these loan level price adjustments decreased. Here's an example of one. Again, at the top of the screen is the multiple unit property adjustment for 2, 3, or 4 unit properties. So prior to May 1st, these adjustments were 1% across the board. Okay, you can see now they've lumped them all together into the new table down here. So you have 2 to 4 unit properties that don't have any adjustment with 40% down payment or more. And then the costs are less than a point all the way across the board. Right. So some of these fees did change for the better. So are the headlines accurate? Right? Like let's kind of cut through the noise here. So again, people see this, a 620 fee, FICO score is getting a 1.75% discount, and the 740 borrower is paying a 1% fee. Well, now that we know how to read the actual loan level price adjustment table, let's look at it. A 620 borrower, okay, is getting a 1.75% fee discount. But look where, only over 95% loan to value. So what they don't talk about on the news is that the only people who can get a loan from Fannie Mae or Freddie Mac over 95% loan to value are first-time homebuyers. Right, the minimum down payment on a conventional mortgage for a first-time home buyer only is 3%, which is 97 LTV. So this whole tier only applies to first-time home buyers. So what they did was they gave a price break to people with the 620 to 639 FICO score if they're a first-time home buyer to help them achieve homeownership. Right, they made it more affordable. If you're not a first-time home buyer and you're putting 20% down, you still get a small improvement in price, but nowhere near as great as what a first-time home buyer is getting, right? Not even in the ballpark. And so if you are a first-time home buyer with good credit, you're hardly getting any price improvement at all. Okay, so first of all, that's the first headline. Okay, the 620 FICO score gets a 1.75 discount. The second one was the 740 score paying a 1% fee. Well, if you look at the 740 category, nowhere in the grid did the fees increase by 1%. Okay, the largest increase we saw was at 15% down, with a 0.75% increase. So looking at the LLPAs outright, you can see someone with a 640 FICO score is still paying way more than someone with a 740. Okay, they're just not paying as much as they were before. And the first-time home buyer with a 640 FICO score is still paying more than the first-time home buyer with the 740 FICO score. Right, so nothing's really changed with respect to credit. So a lot of calls came in saying, "Hey, this is unfair. I'm just not going to pay my bills, so that way I can get better financing." Well, I want to make it clear that's an awful approach because it's just not accurate, right? If you don't pay your bills and drop your credit score intentionally, you're not going to get a better price. You're still going to pay far more than if you have good credit. And obviously, you know, if you intentionally don't pay your bills, you're going to run into other problems in underwriting and getting a mortgage as well. But the misconception is out there that you're not going to get a discount if your credit's worse. You will, if your credit's already worse, you're not going to pay as much as you were before May 1st. But by all means, please do not have people stop paying their bills to get better financing, because that is just simply not accurate. So, you know, let's talk about for a second why they changed these fees. You know, what was the impotence for this? So again, remember, Fannie and Freddie are regulated and overseen by the FHFA. So the official language was that they are maintaining support for borrowers limited by income, right? And that is true, right? So typically borrowers with less income have low to moderate income borrowers tend to have lower FICO scores because they're carrying more debt, right? They have less income to pay their bills. So FHFA's mandate is to try to make homeownership more available to Americans, particularly those with low to moderate income. So it only makes sense that they would lower the cost for the lower credit tier borrowers, as long as the risks weren't increasing. So they also need to ensure a level playing field for large and small lenders, right? So again, these are all applied evenly and equally to all banks. It doesn't matter what lender you go to. If the lender is going to deliver the loan to Fannie Mae, these fees are all the same. And ultimately, their other rationale was fostering capital accumulation for Fannie Mae and Freddie Mac. So again, like they need to make money. So Fannie Mae and Freddie Mac are very profitable. Their profits are down almost 50% this year over last year, though, due to a decline in volume. And they do need to stay healthy. So they are, you know, there's some justification for increasing the fees for operational expenses and to mitigate risk that they have to pay out. So ultimately, though, you know, why'd they really do it? Because if you look at the default rate based on credit score, it's not as significant as it once was. So this chart is showing two lines. The blue line, let's look at that first. The blue line is a pool of loans that was sampled back in 2005 to 2007, prior to the financial crisis. So back then, you could see that with borrowers with a 620 to 640, even 660 credit score up here in this range, at a default rate of between 6 to 8%, right? So 6% of the loans that Fannie Mae and Freddie Mac were securitizing were defaulting at lower credit scores. As credit scores improved, then the default rate significantly dropped. Okay, and this is when the loan level price adjustment tables were last updated, right? So it's based on historical data and historical risk. If you look at a sample of loans after the financial crisis from 2013 to 2015 in this example, you can see that the default rate is less than 0.5%, and it really doesn't matter so much anymore whether the borrower has a 620, 640, 660 credit score or a 780, right? It obviously does decline as you get higher in FICO score, but the delta is way lower. So there's not as much risk based on credit score anymore, right? So again, is it necessary to charge people with lower FICO scores more or less? Well, based on the data, they could make the adjustment that there's less risk and we can adjust the cost. So this is another reason why they've made that change. But that's a general walkthrough of it. And, you know, overall, really the biggest impact to the decline in defaults has been just due to tighter credit markets since the financial crisis, increases in regulation, you know, improved underwriting scrutiny by lenders. You know, it's people that borrow money today are able to repay the money, right? Like the qualified mortgage rule, the ability to repay rule, all of those rules that were put in place by Dodd-Frank Act and the regulation after the financial crisis really did change the landscape of lending. And we do scrutinize people a lot closer than we did before the financial crisis. And it makes a difference in their ability to repay, and it decreases, as you can see, the default rate considerably. But that's essentially a walkthrough of the LLPA changes. We hope that that clarified for you guys what those changes were. And if
Chris,
there are any questions at this point, we'll open it up to questions and comments.
can you hear me?
Yeah, Lori, sure.
Okay. Can you just throw up the chart, the new chart, so people can just see that lower credit borrowers are not paying less than higher credit borrowers? Because I think there's still some confusion about that.
Yeah, so let me share this screen here. So the easiest way to see that would be on this heat map. Throw this up. Okay, so this is the loan level price adjustment chart with color coding in it, right? So again, anybody with a 720, 740, 760, 780 credit score, you can see what the loan level price adjustments are as you move across the columns, right? So 0.75, 1.25, as credit score increases and loan to value decreases, they improve. If you look at the bottom, towards the bottom of the chart, below a 700 FICO score, you can see that the costs are significantly higher, right? And that's what the color shading is showing you. Anything in red is got the highest cost, right? So someone with a 639 or less or lower FICO score, putting 15 to 20% down basically is paying 2.875% of the loan amount in fee. And that same scenario for someone with a 720, they're only paying 1.25%. And if someone has a 780 or better, they're only paying 0.375%. Right. So it's clear here that borrowers with lower credit scores are paying significantly more in cost. Now you can also see if you're putting, 70% down or more, there's no adjustment, right? There's the down payment mitigates the risk regardless of FICO score. So it's all relative to a combination of FICO score and how much equity they're investing into the property via a down payment. Lori, does that make more sense?
Yes. And I don't know if people still are confused. There was a couple of things in the chat where people are asking if it's better to have a lower credit score, but in no case is it better to have a lower credit score.
No, in no case is it better. And again, this was all part of, there's some other headlines and news articles out there about people saying, well, I'm just going to intentionally lower my credit score to get a better price on my mortgage. And what those folks are looking at was this chart, right? So they're saying, oh, well, look at this. If you're just looking at this chart, which shows the change in price, right? Yes. I understand where they're coming from. Someone with a 740 FICO score and 15% down is seeing a 0.75% increase in their cost to borrow money. That's a fact. It's more expensive today than it was last month for someone with a 740 FICO score to borrow money. And yes, it is cheaper by 0.375% of the loan amount for someone with a 620 FICO score and 15% down to borrow money. So that's a fact. But even though it's more expensive today for the 740 borrower, it's still nowhere near as expensive as if they had a 640, right? So it's still more expensive overall for someone with lower credit to borrow money than someone with higher credit. And that's what you need to understand clearly. There's no benefit to tanking your credit score to try to get a better interest rate or cost. It is true, it will cost you more than it did prior to May. Your costs went up, right? but it's still, it would never make sense to intentionally lower your credit score thinking that you're going to get a better interest rate or a better cost, because overall, you can see right here, you're still paying way more with lower credit scores than with good credit scores. Are there any other questions in the chat, Lori?
That was really, here's a question. If I bring a new buyer, low credit score, to buy a $300,000 house with 5% down, how much will they save?
Okay, so for that, we can go back here. So a $300,000 loan amount with 5% down, and what was the credit score?
Well, she said a low credit score, so we could pick, I don't know, you want to pick like a 660?
Sure. So a 660 is going to see a cost improvement. Again, here's 660. I'm moving over to the 5% down category, which is right here. They're going to see an improvement of 0.625% over what they would have paid before. Right. So let me go back to another slide. Just going to move up in the deck for a minute. Okay, so here you go. So the 660 borrower and 5% down is paying 1.625% today. And they were paying, here's the old one. Let's get the old one. So the 660 was paying 5% down, 2.75%. Okay. Now they're paying 1.625%. So it's a significant increase in savings for them. And what does that translate to? Another good question that is, what would that translate to in improvement in rate? Like a 0.625% rate improvement. Let's go back to this slide for a second. Typically that would translate on a rate sheet to a quarter of a point, maybe 0.375% in rate, right? So if that buyer, was getting a 7% rate on any given day in April, then, or March, they may now see a rate of 6.625 to 6.75, right? So it equates to a lower cost and therefore a lower interest rate for that buyer as well. Whereas someone with a 740, that this 0.75% increase is going to raise their interest rate, most likely, a half a point to 0.625% rate, right? So the middle tier of buyers is seeing the largest increase in their costs, and therefore that translates to the largest increase in mortgage rates. Whereas the lower FICO score borrowers are seeing the biggest improvement in cost, therefore they're seeing the biggest improvement in interest rate.
Hey, Chris, I got a question.
Yeah.
Maybe not a question, but more so a point to this. I mean, it seems to me like this is now going to entice those people who were almost automatic FHA buyers that were, the 680 below, even the 685 credit scores. This is now going to almost entice them to get into conventional financing, whereas before the adjustments were just crushing them and you had to flip them FHA to make it make sense. So is that part of the motivation of this?
It is. It's to make conventional financing more available to low to moderate income borrowers that typically have lower credit scores, right? So they're trying to expand the offering of conventional financing to lower credit score borrowers by making it more affordable. And they're making that determination based on the fact that default rates for people with lower FICO scores are not really a thing anymore, right? There's really not a significantly higher default rate for people with lower credit than higher credit. So they're decreasing the cost. It's no longer as expensive as it was to get a conventional loan with a 640 or 620 FICO score. Now it's cheaper, and it's particularly cheaper and less expensive here in the 95 and over category, which is your first time homebuyer bucket. So yeah, exactly. They're trying to open up conventional financing to lower credit score borrowers by making it less expensive.
So,
And-
so I think the narrative to any of our referral partners should be, this is going to only help, because now those people that have the stigma attached to the FHA offers, they may now be able to go conventional where before it just didn't make any sense. So I think you're going to have some fringe people that can now be flipped conventional and potentially have more offers accepted. I mean, that's the way I would look at this.
Absolutely. Even it is still far easier to get any buyer approved for FHA financing.
Right.
And that misconception in the marketplace about FHA versus conventional is unfortunate,
Yeah.
but it exists. It's something that we deal with every day. But yes, this would open up conventional financing to FHA buyers. We would always look at the math and figure out, which scenario is better for the borrower. But it could very well be the case that conventional financing is cheaper because of the lack of mortgage insurance premium from the FHA. We don't have that on a conventional loan. And yeah, it could definitely open conventional doors for buyers who were formerly relegated to FHA only.
There's a couple more questions if we have time.
Yeah.
Someone asked, if interest rates go down, do the charges change?
No, these charges are static. They don't change. I mean, when they do change, it's very, very rare. So we just saw the change and the headlines that came from it. So no, it doesn't have any impact on rates do not have any impact on loan level price adjustments or the charges. These are set in stone, and again, equally charged to all lenders across the country that deliver loans to Fannie Mae. So no, will not change with interest rates.
And then the next question is, do you think that these adjustments will bring more buyers? And if so, what is the government doing about building more houses?
Yeah, I do think that these adjustments will bring more buyers, specifically first-time home buyers, because it'll make it less expensive for them to secure financing, right? And that's really the aim of why they did this. They want to expand home ownership. The other part of that question, with regard to inventory, yeah, that remains a challenge. I was at a presentation yesterday. There was a statistic thrown out. There's currently, I'm going to ballpark the number here, I think nationwide, there's 960,000 active listings across the country for homes for sale. However, 500,000 of those, 500,000 of those are already under contract. So there's less than 500,000 active listings available in the market right now. And there is obviously a massive disproportionate amount of home buyers who are looking for homes. So, the inventory is going to remain an issue, but it's also good for home values because that demand is not going to go away. And as we move into recession, historically has actually been great for home values. So we don't foresee any drop in home value at all. But the inventory is definitely going to be an issue for the foreseeable future. So I don't know what they're going to do to build more homes. Hopefully the builders get busy.
You have time for another one?
Sure.
So there's a question about rates, and can you speak to, this would be two parts, how the Fed raising prime affects our rates, and what are your predictions for the rates?
Sure. So yeah, when the Federal Reserve raises interest rates that we hear about in the news, the quarter point increase that happened, that doesn't have any bearing on mortgage rates. So that's the federal funds rate. That's the rate at which banks borrow from each other overnight, and it has a direct impact on prime. It has a direct impact on debt, consumer debt that's tied to the prime rate. So think auto loans, credit cards, anytime home equity lines of credit, second mortgages, anytime the Fed raises the funds rate, prime goes up, and all of those consumer debt rates go up with it. Mortgage rates are completely independent of the Fed funds rate. Mortgage rates are more directly tied to a different bond altogether called a mortgage-backed security. And so when Fannie Mae and Freddie Mac buy all these loans from us, they form bonds and sell them on the market, and that's what controls interest rates, is the performance of those bonds. As far as where those rates are going, that is all directly correlated to inflation. Okay, so mortgage rates move almost in lockstep with inflation. So as inflation rises, mortgage rates go up. As inflation declines, mortgage rates come down. So there's a very strong argument to be made, and we're going to potentially see some favorable numbers on May 10th when the next round of inflation data comes out. That's going to show year-over-year decline in inflation, which is going to translate to lower rates this summer. So if I had to take a stab at it, I would say that we have a good chance of seeing interest rates in the 5s over the summer. So, as far as moving much lower than 5%, it may take a little more time for us to get back down into the 4s. But based on inflation numbers and based on where the market seems to be heading, it's fair. I think a fair assessment to say we'll see interest rates in the 5s this year, and hopefully as soon as this summer. That's my prediction. There's another question. Rates just went up another 0.25%. So again, that 0.25% increase that you just saw was to the federal funds rate, which again does not impact mortgage rates. Mortgage rates did not go up 0.25% this morning. Actually interest rates are about a full point lower. Mortgage rates are a full point lower than where they were several months ago. So the mortgage market's already started to improve, and it's because the inflation numbers are coming down, right? So there's a big difference between.
Chris, I would want to add that Mortgage News Daily had an article yesterday about how we have the lowest mortgage rates in weeks after Fed hike rates, and how there's that confusion in the housing market, and how the Fed rate hikes are that confusion around the implication of Fed rate hikes. That's a good article yesterday came out.
Yeah, I'll put on the screen here the website that you're referring to. So this is Mortgage News Daily, and this is a great place for anybody to follow along with the mortgage market. There's articles on here. There's also a daily rate survey that gets published every day, which is a survey of actual lenders. These are not advertising rates. This is not bankrate.com or LendingTree. These are not rates filled with points and fees, to try to get people to click on them. This is an industry site, but this is a great site where you can actually follow along with what's happening with mortgage rates. You can see that the average 30-year fixed rate this morning is around 6.75%. That's down from a high, after over the past few years, we were up in the 7s. So we are about a point lower. You can see here on this simple graph, that things are slowly and surely improving. But we do see these rates continuing to drop in lockstep with improved inflation readings. So just keep your eyes on the inflation numbers. If you see inflation come down, pretty much tells you that mortgage rates are coming down with it.
Hey, Chris, you may want to refresh that. It's showing 6.5.
No, sorry, 6.5. There you go. That was from yesterday. So that's another good example, guys, of the volatility day over day, right? So, just simply by refreshing my screen from yesterday to this morning, rates are down a quarter point. And we are seeing large moves in rate like that. Quarter point, half point swings over a matter of days. Just keep in mind, like, that does impact a buyer's affordability. So it's real important to keep an eye on the market, keep an eye on interest rates for buyers, making sure that the rate swings don't price them out of particular deals. But there's a lot of volatility day to day. It's not typically every day we see rates drop a quarter point overnight. So, yeah, this is, again, just a great site to follow along with actual mortgage news and keep a finger on the pulse of the market. So, if there's no other questions, we thank you for attending and coming. If you do have any other questions and want to follow up with us, please feel free to reach out to any of us or your contacts at EPM, and we'll keep you guys posted on other webinars and informational sessions that we're going to be running in the coming weeks. But thanks again for attending. Have a great day.